Hello class, my name is Armando Salvador. This presentation summarizes my final risk assessment and mitigation plan for Valley National Bank. This serves as an extension to preliminary risk assessments done during previous assignments, and it focuses on pure risk, exclusively on pure risk, those that involve the possibility of either a loss or no loss. So Valley National Bank is a regional financial institution headquartered in Wayne, New Jersey. They've got more than $60 billion worth of assets. The purpose of this project is to identify and evaluate 5 primary pure risks. That would be credit, liquidity, compliance, cybersecurity and fraud, and employee insurance cost risk. Each will be assessed in terms of likelihood, impact, and mitigation, applying the risk management principles described in our main course materials. So in banking, risk management is both a regulatory requirement and a business necessity. Rapid changes in interest rates, digital threats, employee benefit costs, and all of that can undermine performance and reputation. A structured framework ensures that Valley National Bank can anticipate losses, comply with oversight agencies, and maintain customer trust. All right, so this analysis follows the classic framework outlined in our textbook by Cather and Dorfman, identifying, classifying, and then mitigating the pure risks. Risks here were grouped as whether they were financial risk, operational risk, compliance, or human resources related. Supporting guidance on that came from the Basel Committee on Banking Supervision, the FDIC, and the Kaiser Family Foundation, more specifically dealing with health insurance risk. This blend of theory and regulation anchors the plan in both academic and industry standards. It's peer group related. And as below, you can see the different risk groupings. So credit risk being the first one. So what is credit risk? It's a financial risk. It's classified as a financial risk, and it occurs when borrowers fail to repay their loans. That causes direct loss. So it's a pure risk. Valley National Bank's highest exposure lies in commercial real estate, which is, and also in SBA or small business loans. These tend to come with higher probability of default. These are more risky loans, but they're also higher yielding, and a lot of times come with prepayment penalties, which make them attractive because they're, typically they don't prepay. Um, Mitigation strategies for this sort of risk involve stronger underwriting criteria, predictive analytics, portfolio diversification, and regular stress testing to ensure capital adequacy. And that's from the Basel Committee on Banking Supervision 2023. Compliance risk results from failure to meet legal or regulatory requirements. To manage this, Valley National Bank should implement automated transaction monitoring. It should schedule ongoing staff training and commission internal and external audits. A board level compliance committee reinforces accountability and supports the culture of ethical conduct. So training is definitely key here, and you'll see this in a lot of financial institutions. Regular compliance training is essential for success in mitigating this risk. If you got all of your department heads and staff on board, um, that's a real game changer. Liquidity risk is another financial risk. It arises from the inability to meet short-term obligations without incurring loss. Valley can address this by a couple of different things. Maintaining high quality, very liquid assets, for example, U.S. Treasury bonds, diversifying funding sources, and conducting quarterly liquidity stress tests. Also, compliance with Basel III liquidity ratios demonstrates fiscal strength and transparency. Just another thing I'd like to add is the maximization of borrowing capacity via asset collateralization. What I mean by that is you're able to borrow as a bank, you're able to borrow from federal agencies as long as you have um, collateral to borrow against that you can put up. So that would be something like certain investments, for example, even 1 to 4 residential mortgage loans can be used as collateral to borrow against. So, not saying you should, obviously don't borrow against it unless there's a funding need, but having that available capacity there as a just in case actually serves as a form of insurance against liquidity risk. We're also going to address cybersecurity and fraud. That represents critical operational risk in digital banking. Valley National should invest in layered protections against this. Some of the examples of that would be multi-factor authentication, intrusion detection, and encryption. Routine penetration testing, phishing awareness training, again, kind of ventures out into the compliance section, and a defined incident response plan that helps prevent certain losses. Cyber insurance coverage also further enhances the recovery capacity. So, health insurance cost risk. I know it's kind of a different type of label, but this falls under human resource risk. That's where I would categorize it, and that's who I would think would own this type of risk in an organization. Rising health insurance premiums pressure profitability. So, according to the survey, the Kaiser Family Foundation, employer premiums outpace inflation and wage growth. Valley National Bank can mitigate this through multi-year insurer contracts, employee wellness programs, possibly self-funded or captive arrangements to control volatility while maintaining coverage quality. So, just overall speaking, on an organizational cultural level, risk management thrives in a transparent, communicative culture. Every employee should understand how their actions contribute to the organizational stability. Regular meetings should be held, policy briefings, and cross-departmental collaboration promote early detection of any issues. And as Cather and Dorfman note, open communication strengthens ethics, compliance, and morale. Risk awareness should be embedded at all levels in the organization. Open communication prevents escalation. As you can see on the slides here, I'm just reading it off. Shared accountability builds trust and compliance. Cultural change can serve as a human firewall. Also, some key metrics or KPIs for success. And so, to make it more like a SMART goal, a metric targets for success should include to address specifically credit risk. We're going to want to see our non-performing loans at less than 1.5%. That's not a hard ask. Liquidity coverage ratio greater than 120%. Again, that addresses liquidity risk, and it's not a hard ask because, especially if you consider that your coverage ratio is actually enhanced by an enhancement to borrowing capacity with federal agencies. Zero regulatory fines imposed. That to me is a hard ask, but it is a necessary element of this. No major data breaches. Again, it's challenging, but that is a smart goal to arrive at. And lastly, the last one is definitely hard to manage. Health cost growth at less than 5% annually. We know that health insurance costs grow astronomically every year, and every year is a challenge to keep these under control. 5% is a little bit tough, but I think that it's doable. In conclusion, managing pure risk safeguards the bank's financial health and reputation by integrating preventative actions, regulatory compliance, and strong risk awareness culture. Valley National Bank reinforces long-term stability and public confidence. Effective risk management is not just about avoiding loss, but it's about sustaining integrity and trust within the financial system as a whole. And then lastly, my references. Okay, well, thank you for listening. I appreciate it, and take care.